Let's see an example of a gain, loss realized and recognized by C Corp shareholders on contributions. Well, maybe not examples yet, but we got a few things going on here. In this example, we will first calculate the tax gain or loss realized and recognized by the shareholders and the corporation on a contribution. Then we're going to calculate the gain or loss realized and recognized by the shareholders and the corporation on a distribution in complete liquidation. So we're constantly going back and forth between transactions with the shareholders, which are the owners and the entity, also dealing with contributions, loans, and distributions. We're seeing it all. We're making sure we got this down. First off, we got a contribution to a C Corp. Shareholder A contributes a piece of land to Corp ABC in exchange for additional shares. The land has fair market value of $150 and an adjusted basis of $50,000 in the hands of shareholder A. So what is the tax gain or loss realized by shareholder A here? Well, the realized gain, that's going to be the fair market value of the land minus the adjusted basis of the land. 150 minus 50, giving us 100. What about recognized by shareholder A? Well, as long as the contribution qualifies for what we talked about, if you control at least 80%, then the recognized gain would be 0. Let's assume that's the case. But if it's not, you're going to pay tax on the difference as if you just sold it. So whatever the value of the stock you're getting in exchange there, it's the value you're receiving minus the value you're giving up. And then what is the gain or loss realized and recognized by Corp ABC? So the corporation takes a carryover basis in the contributed property. Therefore, there is no gain or loss realized or recognized here. We're just taking the basis of the property that was contributed. There we go. You could also think of the journal entries. I know I was talking about the financial exam, how you don't want to think about that, but think about the journal entries that happen. That could help in some circumstances. It may hurt in some others because obviously this is cash basis, but the journal entries will still be made the same. All right, now we're seeing a complete liquidation of a C Corp. Assume Corp ABC's total assets have a fair market value of $800,000 and an adjusted basis of $500,000. The corporation distributes all its assets to shareholder A in complete liquidation. Shareholders A's basis in Corp ABC stock is $200,000. So what's the tax gain or loss realized by shareholder A? So what really happened? This is the easiest one because what really happened? You got $800,000 of value. You originally had an investment of $200,000. So yeah, you have $600,000 of realized gain. What about recognized? Well, in a complete liquidation, the recognized gain will be equal to the realized gain. Therefore, shareholder A recognizes a gain of $600,000. What are the implications for corporation ABC? Well, when ABC distributes its assets in complete liquidation, it's treated as if the corporation sold the assets to shareholder A at their fair market value. So realized gain by Corp ABC is the fair market value of distributed assets minus the adjusted basis of the assets, which is $800,000 minus $500,000, giving us $300,000. The recognized gain by Corp ABC. So in complete liquidation, the recognized is equal to the realized. These are rules that would be definitely helpful to memorize and for you to know. So therefore, Corp ABC is going to recognize a gain of $300,000. Keep in mind that you have to take into account the tax implications because that recognized gain would get taxed, and then as such, you will have less money to distribute to shareholder A. So that's why there is a lot of tax planning involved in something like this. Time to run through an example here. We've got gain or loss realized and recognized by C Corp shareholders on non-liquidating distributions. We're going to assume that Corp ABC has total assets with a fair market value of $600,000 and an adjusted basis of $400,000. Now, Corp ABC makes a non-liquidating distribution of cash and property to shareholder A. You want to think of examples? Think about this like you getting a dividend from a company, but also you probably wouldn't get property from that company. You're not getting a truck or land from Apple. You're just getting a cash dividend. The distribution consists of $50,000 in cash and a piece of equipment with a fair market value of $150 and an adjusted basis of $100. Now, shareholder A's basis in Corp ABC stock is $200,000. So a great question would be, what is the tax gain or loss realized and recognized by shareholder A? First, what is realized? What really happened? What gain did we really get? Well, that's just going to be the cash received. The realized and recognized gain will be equal to the amount of the cash received, which is going to be the $50,000. Now, how do we account for the property distribution? Great question. I'm glad you asked. For the property distribution, shareholder A's basis in the property distributed is $100,000, and that is the lower of the corporation's adjusted basis in the property or shareholder A's remaining stock basis. So therefore, the recognized gain from the property distribution here is $50,000. That comes from the fair market value of the $150 minus the basis in the property of 100. And we have 50 from cash, we have 50 from property. So that gives us a total gain recognized of $100,000. Breaking it out separately, first starting with cash, then dealing with property. Great way to do it. No matter if it's S Corp, C Corp, ABC Corp, I'm just a joke, there's no such thing, XYZ, LMNOP, you always start with cash. Even if it's journal entries in the financial exam, I always say start with cash, and that is just also the rule. You do want to start with cash because that could affect basis in some cases, more so with property, but always start with cash, focus on that, see how that affects everything, and then move on to property. Now, on the flip side, what is the gain or loss realized and recognized by the corporation? We have the corporation to think about. No one thinks about the corporation. Always make sure you're thinking about everyone. All right, so on the cash distribution, there's no gain or loss realized or recognized by Corp ABC on the cash distribution. Remember, double taxation is a factor, but it only affects the shareholders. Corporations pay tax on their income, and then the shareholders pay tax on the dividends. So there's no gain or loss realized or recognized. This is just cash being distributed to the shareholder. Double taxation, it does hit the shareholder because, well, they would have gotten more money if the corporation didn't get taxed on the money initially. For the property distribution, we're going to take how do we get the realized gain by the corporation? Well, we're going to take the fair market value of the distributed property minus the adjusted basis of the property. So that is 150 minus 100, giving us 50,000. The recognized gain by Corp ABC in a non-liquidating distribution, the recognized gain is equal to the realized gain, and therefore Corp ABC recognizes a gain of $50,000. Memorizing rules such as those will save you a lot of time in the exam, so make sure you're doing so. In summary, in this non-liquidating distribution, shareholder A recognizes a total gain of $100,000, while Corp ABC recognizes a gain of $50,000. All right, all these perspectives, we're seeing them, we're practicing them, we're doing well with them. All right, let's see an example. Gain or loss realized and recognized by C Corp shareholders on distributions, more so in general. We've got a corporation that distributed a building with a basis of $30,000 and a fair market value of $90,000, but was subject to a non-recourse liability of $100,000 to its sole shareholder. Interesting, nice little twist here. What amount represents the corporation's recognized gain? Well, if the non-recourse liability attached to the property exceeds the property's fair market value, making it a net liability, the fair market value is deemed to be the amount to the liability of $100,000. When the corporation distributes appreciated property, it must recognize gain equal to the liability over the property's basis, because this is kind of like you're getting rid of a liability. You're getting rid of a net liability and you're benefiting from it. Think of it like a cancellation of debt situation. Think of it, someone else is assuming that debt. So in this case, that would be $78,000 because they had land that was worth $30,000 to them, but there was a liability there. So overall, what is the net gain to the corporation? Again, it is at $70,000. Now, in this scenario, the shareholders' basis in the building would be equal to the fair market value of the property, which is deemed to be equal to the amount of the non-recourse liability attached to the property. And since the non-recourse liability, probably a mortgage, is $100,000, the shareholders' basis in the building would also be $100,000. All right, not bad. Keep powering through. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.